Most investors chasing the S&P 500 this year are up around 7%. One boring dividend ETF most people ignore just delivered 29% in the last 12 months and has returned 481% since 2011. It's called SCHD, and today you're going to learn exactly why it might be the most overlooked wealth builder on the entire market. In the next 8 minutes, 3 things. First, what SCHD actually is and why it's built differently than every other dividend ETF. Second, the real math on what $500 a month turns into over 20 years. Third, the one setting most people miss that can add tens of thousands to your returns without investing another dollar. SCHD is the Schwab U.S. Dividend Equity ETF. It tracks 100 of America's highest quality dividend-paying companies. Not just the ones with the biggest yield, but the ones with the strongest financial fundamentals, cash flow, return on equity, 10 consecutive years of dividend raises. Most ETFs check one box. SCHD checks all 3. That's why it has $91 billion in assets and keeps growing. Here's what most investors don't realize they're giving up. VIG yields just 1.6%. DGRO yields 2.1%. SCHD yields 3.45% right now, today, and its expense ratio is just 0.06%. That's $6 a year on a $10,000 investment. In 2022, when VOO fell 18% and tech ETFs dropped 30%, SCHD fell just 3%. That's not luck, that's quality screening protecting your money when it matters most. Let's talk real numbers. SCHD just paid $0.2569 per share in Q1 2026, a 3.3% increase year over year. The quarterly dividend has grown from $0.04 in 2011 to nearly $28 today. That's a 7-fold increase in income on the same shares. And with dividends compounding at 13% annually since inception, that growth isn't stopping anytime soon. Here is the math that changes everything. $500 a month into SCHD for 20 years with dividends reinvested builds a portfolio worth over $340,000. But here's the part most people miss. That portfolio then generates $11,700 every single year in dividends, without selling a single share. $975 a month in passive income from $500 a month in contributions. The math does the heavy lifting. You just have to start. Remember that 481% cumulative return since 2011 I mentioned at the start. Here is what that actually means in real dollars. A $10,000 investment in SCHD at inception is worth over $58,000 today with every dividend reinvested. The S&P 500 did better over that same period, but SCHD did it with far less volatility and paid you growing income the entire time. For millions of investors, that trade-off is exactly the right one. Here is the one setting most SCHD investors set up wrong or never set up at all. DRIP, Dividend Reinvestment Plan. Instead of taking your quarterly dividend as cash, you automatically buy more shares of SCHD. Those shares pay more dividends, which buy more shares. It is a snowball rolling downhill, getting bigger every single quarter. Most brokerages let you turn on DRIP with one click under account settings. This single setting can add tens of thousands of dollars to your portfolio over 20 years without investing another dollar. 3 ETFs fight for your dividend dollars. VYM from Vanguard holds over 400 stocks with a higher yield but a weaker quality screen. DGRO from iShares focuses on dividend growth with a lower current yield of just 2.1%. SCHD holds 100 stocks yielding 3.45% today and runs a triple quality screen on every single holding. SCHD is not the biggest or the oldest. It is the most complete package. That is why it now manages $91 billion in assets and keeps growing. 3 mistakes are destroying SCHD investors' returns right now. Mistake 1. Selling during dips. SCHD dropped on tariff fears earlier this year, then recovered fully. Sellers locked in losses, buyers got shares on sale. Mistake 2. Taking dividends as cash. It feels good, it costs a fortune over 20 years. Mistake 3. Waiting for the perfect time. SCHD has paid a growing dividend through every recession, every rate hike, and every market panic since 2011. There is no perfect time. There is only time in the market. Here's what the smartest long-term investors actually do. They do not just own SCHD, they pair it with VOO. VOO gives you growth. SCHD gives you income. Together, they cover both sides of wealth building. A popular split is 60% VOO and 40% SCHD when you are young, then gradually shift toward more SCHD as you near retirement. Next week, I am breaking down exactly how to build and rebalance this portfolio at every age. Subscribe now. It might be the most important finance video I make this year. SCHD has paid a growing dividend every single quarter since 2011. Through recessions, through rate hikes, through pandemics, it did not stop, it did not cut, it grew. Drop the word dividends in the comments right now if you are adding SCHD to your portfolio this week. I read every single one. And if this video showed you something you did not know before, hit the like button. It takes 1 second and it helps more people find this channel. See you next week.